All right, if you care about markets at all, you need to pay attention to what just happened. And yeah, hit that subscribe button if you want real-time breakdowns like this, because silver just erased roughly 15% in a matter of days after one of the fastest runs you've ever seen. We're talking about a move that felt unstoppable, straight up toward that 120 zone, and then, bang, control lost. What matters isn't just that silver dropped, it's why it dropped, and why this moment right now could decide whether the next move is delayed or detonated. Stay with me, because I'm going to show you what actually triggered this and how you can spot it next time before the crowd does. If you're holding silver, if you're watching commodities, if you're trying to understand how markets actually work when they break, this is the moment that teaches you more than 100 textbooks. Before I explain what caused this, let me teach you something most people never really internalize. Markets don't move because of headlines. They move because of positioning. Think of price like a crowded elevator. It can go up fast when everyone piles in, but the moment someone yells fire, the rush to get out is violent. Silver wasn't just rising, it was becoming crowded, leveraged, loved. And when you're in a market like that, you're not watching price anymore. You're watching balance. Who's in? How much leverage are they using? And what could force them to leave all at once? That's the mindset you need, because price is the effect, not the cause. Price is what you see after the real battle's already happened behind the scenes. So when experienced traders look at a move like this, they're not asking whether silver's going up or down. They're asking who's trapped, who's overextended, and what trigger could force everyone to liquidate at once. If you can learn to see markets this way, you'll start seeing moves before they happen. If this is making sense so far, drop a comment and let me know if you caught this move, or if it caught you off guard. I want to hear where you're at. Now here's what's actually happening under the hood. Let me break down the sequence because this isn't random chaos. Silver rallies hard, faster than fundamentals alone would justify. That attracts momentum traders, hedge funds, leveraged longs, and algorithmic systems that chase strength. You've got retail piling in. You've got institutional money adding positions. And you've got derivatives dealers on the other side trying to hedge their exposure. At the same time, silver is priced in dollars. So when the US dollar suddenly surges, like it just did after renewed uncertainty around Federal Reserve leadership, that's not just a headline. That's a mechanical shock. A stronger dollar instantly pressures commodities. It makes silver more expensive for foreign buyers. It changes the arbitrage calculations. It shifts the entire playing field. So when that dollar spike hits, margin requirements tighten, volatility jumps, and leveraged players don't get a choice. They're forced to unwind. Selling begets selling. Stops get hit. Liquidity vanishes. What looks like volatility is actually a vacuum. Here's the secondary confirmation that makes this even more dangerous. While the dollar's spiking, you've got positioning data showing silver futures had reached some of the highest net long levels in recent history. That means speculators were all leaning the same direction. And when everyone's leaning one way, there's nobody left to buy. The fuel for the rally runs out. But more importantly, when conditions shift, all those longs become sellers simultaneously. It's not that they want to sell, it's that their risk management systems force them to. Their brokers demand more margin. Their stops get triggered. Their algorithms detect momentum reversal and flip. This isn't emotional selling. This is mechanical liquidation. And mechanical liquidation doesn't care about your conviction or your thesis. It cares about math. But here's the part that should make you nervous if you don't understand this. These moves don't wait for confirmation. By the time the chart looks ugly, the damage is already done. By the time you're seeing headlines about silver crashing, the smart money's already repositioned. So when the dollar pops, silver doesn't politely drift lower. It falls through air pockets created by its own success. That's the cascade. Primary trigger, dollar strength. Secondary confirmation, overcrowded long positioning. Together, they matter because neither one alone would have caused a 15% flush. A dollar rally without overcrowding? You'd get a modest pullback. Overcrowding without a catalyst? You'd get choppy consolidation. But combined? That's how control gets lost. That's how you get air pockets where there's no bid. And if you're only watching price, you miss the entire story. You're seeing the car crash after it already happened. You're not seeing the ice on the road that caused it. Now zoom out with me for a second, because this isn't new. This is the exact same playbook we've seen before, and if you understand the pattern, you'll stop being surprised by it. In 2011, silver went absolutely parabolic, hitting nearly $50 an ounce. Everyone said it was going to 100. The narrative was unstoppable. And then what happened? A violent sell-off followed. I mean, brutal. Silver lost nearly half its value in weeks. Sentiment collapsed. Everyone declared the trade dead. Permabulls looked ridiculous. And yet, it wasn't dead. It wasn't over. It was resetting. Fast forward to 2020. Silver ripped higher during the pandemic, jumping from the mid-teens to nearly $30. Momentum was intense. Retail was flooding in. And then it corrected brutally, pulled back hard, chopped around. People said the same thing. Trade's over. Fundamentals don't matter. Manipulation won. But then what happened? Silver resumed its structural move as supply constraints reasserted themselves, as industrial demand came back, as the fundamental story played out over quarters and years, not days and weeks. Every time this has happened, the drop felt like the end in real time. I remember watching those moves. The fear was real. The pain was legitimate. But when you look at the pattern, these sell-offs marked inflection points, not funerals. They were chapters, not conclusions. The larger story is that parabolic moves reset through pain, not through boredom. And that's uncomfortable, especially if you're watching it tick by tick. Nobody wants to sit through a 15% drawdown. But if you zoom out, you'll see that these resets are what allow the next leg higher to even be possible. They shake out the weak hands. They clear the overcrowding. They restore balance. And then, when conditions align again, the move resumes with less resistance because the elevator's not as crowded anymore. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this keep going lower? Absolutely. Could this correction take longer than people expect? Yes. Could we see silver back in the low hundreds or even the 90s? It's possible. And here's the thing about manipulation narratives. They're emotionally satisfying, but they don't help you make decisions. I get it. People want someone to blame. They want to believe there's a villain controlling everything. Maybe there is. Maybe there isn't. But you can't control headlines or central banks or what some algorithmic trading desk in New York decides to do at 3 in the morning. You can control your risk, your timing, and your awareness of structure. Focus on what you can measure. Dollar strength. You can measure that. Positioning data. You can track that. Liquidity conditions. You can observe that. Those are the levers that matter. Conspiracy theories might make you feel better, but they won't protect your capital. There are probably 3 types of people watching this right now. Let me talk to each of you directly, because your situation's different, and the advice should be too. First, you're the trader who chased the breakout and now feels punched in the gut. Maybe you bought silver at 115 thinking it was going to 130. Maybe you added leverage because the momentum felt unstoppable. And now you're down 10, 15, maybe 20% depending on when you got in. Let me say this clearly. You're not stupid. You're not a bad trader. You just learned in real time what crowded trades do when conditions flip. Your job now is capital preservation and patience. Don't revenge trade. Don't try to make it all back in one position. Accept the loss if you need to, reduce your size, and wait for clarity. The market will give you another opportunity. It always does. But only if you're still in the game mentally and financially. Second, you're the long-term bull who believes in silver's fundamentals and feels vindicated by the chaos. You're thinking, this is exactly why I stack physical, why I don't trade, why I hold for years. That's fine. I respect that conviction. But don't confuse conviction with timing. Structure still matters even for long-term holders. If you're planning to add to your position, wouldn't you rather add after a flush than before one? Fundamentals are real, but they play out over time, and in the short term, price can do whatever it wants. So stay convicted, but stay aware. Don't let belief turn into blindness. Third, You're the observer who missed the run and thinks this is all noise. You didn't buy silver at 90. You didn't chase it at 110. And now you're watching this drop thinking, see, I was right to stay out. This whole thing's a circus. For you, this is education. Watch how fast sentiment flips. Watch how price behaves near key levels. Watch how quickly heroes become villains in market narratives. The universal principle for all of you is this: don't confuse volatility with invalidation. Just because something's volatile doesn't mean it's wrong. Just because a trade's painful doesn't mean the thesis is broken. Volatility is information. Learn to read it instead of fear it. So here's what I want you to answer in the comments. Which of those three are you? Are you the trader who got caught, the long-term holder staying patient, or the observer learning from the sidelines? I'm genuinely curious where you're at, because it helps me understand what kind of content serves you best. Now here's where I stand. I'm not panicking, and I'm not pounding the table. I'm watching. Let me tell you what I'm personally watching. First, I'm watching the dollar. If dollar strength holds and we see the DXY pushing higher into the mid-105s or beyond, pressure on silver remains. That's not a prediction, that's just mechanics. A strong dollar is kryptonite for dollar-denominated commodities. So if the Fed commentary stays hawkish, if yields stay elevated, if global risk-off conditions persist, the dollar could stay bid, and that keeps a ceiling on silver. Second, I'm watching how silver behaves after this flush. Does it stabilize around key technical levels, or does it keep bleeding? If silver finds support and starts building a base, that tells you the forced selling is done. If it keeps grinding lower with no bounce, that tells you there's still more liquidation to work through, or the fundamental bid isn't strong enough yet. Third, I'm monitoring positioning data. The COT report, the futures open interest, the options skew. When those start showing that speculators have unwound their positions, when the overcrowding clears, that's when you know the reset is complete. Based on my analysis, this move was mechanical, not emotional. It was structural, not sentiment-driven. The fundamental picture hasn't disappeared. Industrial demand for silver is still there. Supply constraints are still real. The energy transition still requires massive amounts of silver for solar panels and electric vehicles. Central banks around the world are still holding enormous amounts of debt. Inflation concerns haven't vanished just because silver pulled back 15%. None of that changed. What changed was positioning and the dollar. And those are temporary conditions, not permanent shifts. If history rhymes and silver consolidates here, builds a base, and clears out the excess leverage, the move that follows could make this flush look like a minor interruption. Not a prediction, just pattern recognition. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Make your own decisions based on your own risk tolerance and your own financial situation. But if you made it this far, you're the kind of person who thinks critically, who wants to understand how things actually work instead of just reacting to headlines. That mentality will serve you well. Share this with someone who needs to see it. Subscribe if you want more real-time breakdowns when markets move. And remember, markets teach you more in moments of chaos than they ever do in moments of calm. Stay sharp out there, think critically, verify everything, and make your own decisions.